So hello everybody, good evening, welcome to JAIIB English Medium channel. I hope all of you are doing fine. Today in this particular session, we will be talking about the IE and IFS subject. And in IFS, we will be studying the one unit of module D, which is fixed income markets. So when we talk about unit number 32nd, it is one of the most important one. Why? Because it will define that apart from the variation which is there in the markets, whether there is a specific instrument which will give you some fixed income. And yes, we will be talking about all those instruments in this particular unit. So be it in case of debt market or for that matter bond market, everything will be studied under this particular unit. And how we will be approaching this particular unit, starting off with some basic concepts pertaining to your government securities, pertaining to the PDs, primary dealers. Also we will be defining what is FIMMDA, whether corporate bond market is different from the other fixed markets, fixed income markets, and then we will be moving on to solving certain MCQs. So if you are new to this channel, I would highly recommend to subscribe our channel, because we try to bring the quality content on this particular JAIIB English Medium channel. So let's start our discussion with the first topic, that is the introduction. So introduction means we will be talking about all these topics briefly which are present in this particular chapter. Okay, we will be talking about what all terms are there. So fixed income market, simply stated, it means that you have already certain information regarding the income you will be having while investing in a particular market. In equity, what happens, you never know. If the market goes up, your profit will rise, but on the flip side, if it falls, then definitely you will be at loss. But nothing of that sort happens in the fixed income market. Who are the major market players here? Mostly you will find the discussion around government securities and the corporate bond. So the market comprises of these two big market players, the corporations as well as the government. And when we talk about government securities, whether they are not risky, so answer is no. The least risk which is involved in the entire market, entire financial market also, you can say, it is under the government securities. Now when it comes to the fixed income from the corporate bond market, whether this is highly risky, no, you can say that it is a bit risky as compared to the government securities, but overall the riskiness is nothing when we compare it with the equities. Fine. Next important thing, when you talk about the numerical aspect or for that matter the formulas, so yes, this chapter will test you via some mathematical expressions. So mathematical expressions means what? We will be talking about the bond valuation. We will be talking about the bond theorems, how you will be arriving at a particular price of the bond, whether the fluctuation is happening or not. Based on that, based on the tenure, based on the coupon rate, how the ultimate calculation of the bond will look like, that will be determined by the bond valuation, the mathematical expression. And according to which theorems, or for that matter which theorems are backing that particular expression, the mathematical expression, that is under the bond theorems topic. Next comes the extension of government securities. You know that government will be floating some securities known as G-Secs or for that matter government securities. But how? What is the procedure? So for that, one auction will be conducted on regular basis by the RBI, but at which platform? Whether on the RBI's website only, the rbi.org.in, or is there a separate platform altogether? We will be looking into the auction of government securities. Then comes a very pertinent question, that who all constitute the primary dealers. Right? Primary dealership, you must have till now heard this term of primary dealers in every chapter, be it unit number 29, unit number 30 or 31. And if you have not read the topic of primary dealer on your own, you must be having certain inhibitions, certain confusion in your mind that whether primary dealers are the individuals or for that matter they are a setup which is being organized as an entity. So we'll be answering that also. Who are the primary dealers? Basically the enablers of your government securities market. Next comes one important association. Now this association, why it is important? Because in this fixed income market you will find only a single reference of one market only, one association only, that is FIMMDA, Fixed Income Money Market and Derivatives of India. Although it is SRO, but again very important when it comes to the role it performs in the fixed income market. The roles of your FIMMDA, they form the essential part of the entire discussion around this particular organization. Then we have again the further discussion of auction for your government securities under the RBI Retail Direct Scheme or the RDS. Whether RBI will be having only one type of option on the RBI Retail Direct website, or you can do multiple auctions, or for that matter multiple operations can be performed on this particular website. Everything will be looking into this particular topic. Last is your ICDs, the intercorporate deposits, again an extension of your corporate bond markets. For our examination, what is the most important point? The most important point will be your bond valuation and the theorems along with the government securities. Government securities being the auction of the government securities, or for that matter your RBI Retail Direct Scheme via which the government securities are traded. Fine. Okay. So now let's move on to the discussion of the same. Fine. Let's try to have the discussion of each and every topic. Starting off with the basic introduction, that what is a fixed income market. Let me just scroll down a bit so that all of you can ask the question also. Okay, keep on asking any doubts if you have, fine, pertaining to this particular introduction, or for that matter the intro which we will be looking into the next slide. Fine. So when we talk about the definition of fixed income market, when we are saying that it is commonly known as debt or bond market, we simply mean to say that no kind of speculation is there. Fine. It is devoid of any speculation. So these markets are financial arenas where debt securities are issued and traded, allowing the governments as well as the corporations to raise the capital by borrowing from the investors. Fine. You are borrowing from the investors and ultimately raising the capital for your needs. Government can have n number of needs. Fine. Let's suppose the fiscal deficit is too high in our country. Government can float in the government securities, or for that matter certain corporations, they feel that they want funding for new projects, some expansion is ongoing in their corporation. For that also they can float the bond under the corporate bond market. What are the instruments? It includes government securities, corporate bonds, municipal bonds, treasury bill, or for that matter commercial paper. Commercial paper as well as the CDs we have discussed, fine, in the unit number 30th. So if you are not aware of the primary features or the basic features of the CDs, or for that matter your commercial papers, do go and watch the unit number 30th discussion after this video is over. Next comes the returns. The investors, they receive regular interest payments which is known as the coupons, and the return of the face value. So what is the face value? The value at which the bond is being presented to you. Fine. Ultimately what is happening? You are earning certain interest payments, fine, earning via certain interest payments at regular intervals. And when you have the interest payments, do you think so that only that will be the amount which you have benefited out of this particular investment? Answer is no. Apart from that, you will also be having the principal amount, or for that matter your face value in your account once the maturity arises. Next, we have the risk profile. So definitely they are much more safer as compared to the equity markets, providing lower but more predictable returns. The returns are much more predictable as compared to your equity market. Okay. Now let's start our discussion with the government securities. So who will be floating the government securities? These will be floated by the state government, or for that matter central government. Only two big players are involved here. It includes central government securities, treasury bills, as well as the state government securities, commonly known as the SDL, state development loans. Also, when we talk about the purpose, what is the purpose? Right now you must be having a fresh idea, because the union budget was presented on 1st of Feb. Only 9 days have passed. So you must be having a fair idea that what is fiscal deficit. Fine. Normally we say that in common parlance, when the revenue of the government falls behind its expenditure, we are staring in a situation known as fiscal deficit. And in order to have the finance to overcome this gap between the revenue and expenditure, government often floats the government securities in the market. So they are issued in order to finance the fiscal deficit and managing the temporary cash mismatches of the government. Temporary cash mismatches, not the long term, for short term only. Now comes a part where you must be knowing that there are certain players who are eligible to participate in the purchase of these government securities. So government securities, who all can purchase? Mostly everybody. Mostly, the word is mostly. Be it the banks, financial institutions, the primary dealers. Who are the primary dealers? We'll be looking into that. But for now, just for 15-20 minutes, think of primary dealers as the entities who are the enablers of your securities market, which are floated as government securities. Fine. Then firms also can purchase the government securities, companies, corporate bodies, your partnership firm, institutions, mutual funds. You have the FIIs also, foreign institutional investors. A specific description of FIIs has been given in our economic survey, that because of the unfair trade practices right now ongoing in the global trade, FIIs are leaving our country. So they are also one of the purchasers of our government securities. Then we have state governments, provident funds, trusts, research organizations, and your NRB. NRB is what? Nepal Rashtra Bank, along with the individuals whosoever want to invest in the government security. So all these are the players who can purchase the government securities. Now, how the government securities are traded? Fine. Now we know that who can float the government securities? Central or the state government. Who can purchase the government securities? These are the entities. Now how they will be doing this buying or selling? Via a platform which is provided by the banks through RBI. So we have the government securities generally held by the banks and the institutions with the RBI in subsidiary journal ledger account, the SGL account. You must be knowing, in the banks there is one SGL account, the subsidiary journal ledger account. Here you will be having the government securities. They can be held in special accounts known as the CSGL, constituent subsidiary journal ledger, which can be opened with banks as well as primary dealers. Primary dealers are nothing but the banks only. Fine. NBFCs, some NBFCs, and mostly the banks. Or in demat form, which is being maintained by the depository participants of NSDL. So whenever you have the accounts being opened with bank or primary dealers, under which account you will be opening that? CSGL. And whenever the demat account is being opened, it will be maintained by the National Securities Depository Limited. So two options are there with the participants. These are the participants who want to trade in the government securities. They can either go via the banks and the PDs, or for that matter open the demat account. Banks, PDs, they maintain the accounts via CSGL, and the demat accounts directly who will be maintaining? Your NSDL. Now comes the question that the government securities will be traded, everybody knows, but how? Fine, how? We will be looking into the income. This chapter talks about one fixed income, na? So how this fixed income arises, how you will be able to understand that whether a particular government security will be paying you X amount or Y amount. Let's talk about a simple calculation. So the government securities are issued normally at a par value, fine, and it is in the denomination of 100. Whenever we calculate the interest payment on a particular government security, it will be in line with the amount of rupees 100 and have a coupon rate which is simply the interest rate, fine, the rate of interest which you will be earning as the purchaser of the government security, and it is decided at the time of issue by auction technique. Where is auction happening? It is happening simply at your RBI direct retail. These securities pay interest at coupon rate on the half yearly basis and are redeemed at par value on maturity. So you are earning two things. First, the par value of the bond when the particular security matures, fine, after the maturity. Over the top of it, in single year, twice you will be earning the interest, I1, I2. So half yearly basis you can say that interest will be earned by the participants. What is the example? Because ultimately when we see, look or observe the examples, we learn in a much better manner. So let's suppose there is a bond like 7.99% GOI 2027. So GOI represents what? This particular bond market in this particular situation, GOI represents what? The bond market being governed by the government securities we are talking about. So it is issued. How you will be reading this particular phrase? 7.99 will be what? It is the coupon rate. 7.99% is the coupon rate, and for every 100 worth of bonds you hold, you would receive 7.99 in interest per year, fine, per year. But when we talk about the regular payments, they will be split into two halves, because here it is written half yearly basis. So split into two payments of approximately 3.995 every 6 months. Okay, let me just give you the calculation here also. So this is what? 7.99%. It is the coupon rate, and it is being calculated at par value with respect to rupees 100. So 7.99% for every 100 rupee. 7.99%, you can write it like this: 7.99 divided by 100. Every 100 means what? You have to multiply this coupon rate with 100. These hundreds, they will get cancelled, and we have 7.99 as the annual earning per 100 rupees. But when we talk about the coupon rate, it is for the half yearly term, and the half yearly means what? You will be dividing this interest earning into two halves, and ultimately for per 6 months you will earn how much? This amount, 3.995 rupees per 6 months. Okay, fine. So that's how you calculate, and when you talk about the bond theorem, the bond valuation, we'll be covering that in detail in our paid classes. But yes, this is how the government securities work. Now comes the platform where you will be trading the government securities. Here you can see the screenshot from the Reserve Bank of India Retail Direct, and more or less you will find that the first step will be to open the RBI Retail Direct account. From this account only you will be participating in the fixed income market, specifically for the government securities, fine. So step 1 will be open the RBI Retail Direct account from the website. website is what? RBI Retail Direct. So this is a scheme providing one-stop solution to facilitate investment in government securities by individual investors, which has been issued. Highlights are, first of all, the retail investors or the individuals as we call them, they will have the facility to open and maintain the retail direct gilt account, the RDG account with RBI. Once this is opened via the online portal, this is the online portal, you will be having the various facilities. The first one will be, you can have the access to the primary issuance of your government securities, which is why you are enrolling via this particular scheme. And the second one, in the secondary market also, the NDS OM we have seen in the secondary market chapter, that also you can access via the RBI Retail Direct platform. Okay, so both things, both tasks you can do via this particular website. Next is, what is the procedure for registration? So simply stated, there will be certain documents, there will be certain important procedure involved. So first of all, what all you require to open this retail direct gilt account? You must have a mobile number linked to your Aadhaar, active saving bank account with the net bank as well as UPI facility. That is the primary, you can say, requirement. Signature image of the account holder, fine, the signature must be present. Original PAN, in case we are talking about the video KYC, you must have the original PAN card with you. Also the bank account number as well as IFSC code. But when it comes to the address change, fine, supposingly the address has changed in this particular bank account, the active saving bank account, then what you have to give, the proof of your address change must also be there. Now apart from that, there are certain other conditions. For Aadhaar based KYC, you have to complete the video identification within 3 days, and you have to enable the pop-ups on your PC or mobile, because n number of pop-ups will be there once you will be registering in the RBI Retail Direct. Allowable file formats are JPG, JPEG, PNG, PDF, and the maximum file size will be 5 MB. A very important point when it comes to the registration under your RBI Retail Direct scheme. Now comes the part that how the investors will be receiving the information, whatever they have registered for. So investors can register on the online portal by filling up the form and use the OTP received on the registered mobile number as well as email ID to authenticate and submit this particular form. You will be clicking here, open the RBI Retail Direct account. One page will open, and there you will be filling all the necessary details, and you will receive the OTP on your mobile number as well as on the mail ID. Instructions issued under the RBI KYC Direction 2016 updated from time to time will be adhered to during onboarding the investors. While you are trying to register on the website of RBI to open the retail direct gilt account, you must go through the RBI KYC guidelines 2016, because ultimately all these points are mentioned in that particular guideline itself. Once you are registered, you have successfully registered, the retail direct gilt account will be opened. You will have the RDG number, right? Retail direct gilt account number, and details for accessing the online portal will be conveyed through SMS or email, fine. Then you will do what? Go to login and just enter the details, the login credentials. RDG account shall be available for primary market participation, as we call it, and the secondary market transaction on the NDS OM, fine. So both the processes you can access once you register under the RBI Retail Direct, fine. Here it is mentioned also, login to RBI Retail Direct account, or for that matter in the secondary market we have the NDS OM as well, the second option, fine. Till here, any doubt, any kind of doubt you have? Let me just see. Okay, no doubts, fine. See, keep on asking whatever doubts you are facing right now, because ultimately then only you will be able to understand the topic in a much better manner. Fine. Now comes the point that what is primary dealer. Simply stated, primary dealers, as I was telling also, that they are just the enablers. Fine. They are here to promote the transactions in government securities market. Fine. So the promotion of the transaction in your G-Secs will be done by the primary dealers, and these are what? These are the entities registered with RBI. That is the first important thing which you must understand, that the entities whosoever wishes to act as a primary dealer, it must register with RBI. Why? Because ultimately RBI will provide the license to purchase and sell the government securities. Fine. These are the entities who buy the securities from the RBI, aiming to resell them to other buyers. There will be other buyers also. Fine. The purchasers which we have seen. Then in this way the primary dealers create a market. Fine. They are creating a market for your government securities. Plus, when we talk about the genesis of this particular type of setup, the primary dealers, whether it was there since independence, answer is no. It was started by the RBI or introduced by RBI in 1995 only. Next comes the important aspect, that who all are the primary dealers. Let's go through the examples first, then we will be looking into the remaining topics. So the two lists which you can access here, the first one being standalone primary dealers who are here registered as NBFCs. These are simply the NBFCs who are operating as the primary dealers. Second one, the bank primary dealers. They are providing the functions or fulfilling the functions of being a bank, as well as they are providing the option for being a primary dealer. Fine. They are performing both the functions. So the standalone PDs, what all are there? So we have a list which includes ICICI Securities, Morgan Stanley, Nomura Fixed Income Securities, PNB Gilts, SBI DFHI, STCI primary dealer. Then we have the Goldman Sachs as well. All these are very, very important. Next comes the bank primary dealer. So you can see mostly you must have heard the name of these banks, like Bank of America, Bank of Baroda, Canara Bank. You have the Union Bank of India also, HDFC Bank. So one thing is for sure, not only the foreign banks, not only the public sector banks, but also the private banks are a part of your bank primary dealer setup. Citibank, HSBC, JP Morgan Chase Bank, Kotak Mahindra, you have the Standard Chartered, then Axis Bank, IDBI, Deutsche Bank, as well as Yes Bank. So all these are what? They form the part of your ecosystem known as primary dealers. Right? Okay. So I hope that now you understand for sure that who all are the primary dealers. Now moving back to the arrangement, how the primary dealers function. So a facilitating arrangement is essential for selling of the government securities, as government is the single largest borrower in the market, which borrows through the issue of its securities, that is your treasury bills and the bonds. And this facilitating arrangement will be provided by whom? It will be provided by the primary dealers. RBI, it stipulates various guidelines when it comes to the operational aspect of primary dealers. It can state that yes, this must be the minimum turnover ratio, minimum bidding ratio, minimum underwriting ratio. Why? Because ultimately the PDs are what? They are the underwriters. They are preparing the government securities for transaction in the securities market, in order to ensure that they are active in supporting the trade in government securities. Fine. So very important aspect of primary dealers, that they provide what? A facilitating arrangement so as to have the government securities traded in the market. Now comes the eligibility conditions. We have seen the names, fine, the types, standalone and your bank. But when it comes to the eligibility condition, what are those? First of all, The first condition states subsidiary of the scheduled commercial banks or the all India financial institutions can be a part of your primary dealer ecosystem. There is no you can say exception to that. Subsidiaries of your scheduled commercial banks can also be the primary dealers. Then subsidiaries or the joint ventures who are set up in India by the entities incorporated abroad. Fine. So when we talk about the Bank of America, then we have the Citibank, HSBC, all these are what? The entities which are being incorporated abroad. Then the company incorporated under the Companies Act and does not fall under these two, A or B. Still, that particular company can be a primary dealer. The applicant for PD should register as the NBFC for at least 1 year prior to the submission of its application for the primary dealer. So always remember, whosoever the applicant is, fine, whosoever is the applicant for your primary dealership, they must be at least for 1 year registered as NBFC. And who will be taking care of this registration? RBI. The decision to authorize PD is taken by RBI based on its perception of market needs, suitability of the applicant and the likely value addition of the to the system. So when we talk about the suitability, the market trend, whether it follows with the primary dealer operations or not, whether we need to expand this entire ecosystem of primary dealers or not, based on this market research, RBI will give a heads up to new or for that matter fresh PDs. Fine. Now comes the numbers. When you talk about the numbers in case of primary dealers, first and the foremost point, the data is updated till 2024. Fine. After that, nothing has changed much in the primary dealers. So we have 21 primary dealers, out of which 14 they function as bank primary dealers. Fine. They have a separate department, and 7 will be the standalone PDs registered as NBFCs under the section 45 IA of the RBI Act 1934. A very important point, that they are registered under which particular act? RBI Act 1934. Registered as what? Registered as NBFC. Under which section? Section 45 IA. Next comes the distinguishing factor between the SPD and your BPDs. So standalone primary dealers and bank primary dealers, the most important point of difference is the standalone PDs, they are being registered as NBFCs, and the bank PDs, they do not have such kind of setup. So SPDs are registered with RBI as NBFCs. They can be the subsidiaries of scheduled commercial banks, Indian subsidiaries of foreign entities, or companies which are incorporated under the Companies Act. All these are a part of your eligibility criteria when it comes to the SPDs. They also focus on trading government securities and the related activities. That is what the primary dealers do, right? Examples being ICICI Securities, Morgan Stanley, Nomura Fixed Income Securities and others. Then we have the important primary dealer classification as the bank primary dealers. Here you will find that all those banks which have been authorized by the RBI, they can act as the primary dealer. So these are the banks that have been authorized by RBI to undertake the primary dealership activities as a department within their operations. Right? So banks, they are performing various functions. Over the top of it, they can also participate as primary dealer. They don't have a separate subsidiary undertaking the PD business. Fine. So primary dealership business, more or less, they are directly integrating this particular business with the various departments they have for different roles. Example, Bank of America, Bank of Baroda as well as Canara Bank. Okay. So now I hope that primary dealers are clear to everybody. Fine. Because if you don't know about the primary dealers, you won't be able to make sense of all the topics where the primary dealers are mentioned. Fine. Now before moving on to the FIMMDA, let's try to have a discussion, a brief discussion about the corporate bond market. Government securities we have seen floated by the government. What about the corporate bond market? Who governs this type of market? So simply stated, these are the debt securities issued by companies. which are here to raise capital for the expansion for their certain operations or refinancing the debt. When you talk about the holders or the investors, whosoever will be investing in this particular bond market, they will be receiving regular interest payments which is known as coupon, and the principal amount at the maturity. Fine. So more or less the setup is same, but the players will differ. Who will be issuing these securities? These bonds will be issued by the companies. And what type of companies? Here is the elaborate list. Overall, this market in India comprises bonds issued by various corporations for their normal business activities. What all activities are there? We will be looking into that. But when it comes to the players which are involved, they can be public sector enterprises. The most common, everybody must be knowing, NTPC is also there. Then we have public sector banks for augmenting the additional tier 1, tier 2 capital. What is tier 1? What is tier 2 capital? We will be taking up a separate session for this as well. So we have SBI, PNB, Bank of Baroda, so on. All the public sector banks are listed. Then we have the private sector banks. Again, why they are floating the corporate bonds in the market? So as to augment their capital, tier 1 and tier 2. For AIFIs, All India Financial Institutions, you will find IDFC, NABARD, Exim Bank. They also float these bonds in the market so as to have some additional capital. Then we have the private sector companies, the Tata Motors Limited, Reliance Industries, Hindalco, Grasim, Tata Tea. All these are what? The private sector companies who will be participating or floating the bonds in the corporate bond market. Along with that, HFCs, a very, very important point. Often candidates, they ignore this classification, and when in the examination the same classification is asked, they get confused. So always remember, the facts are very, very important for your IE and IFS, specifically for this particular chapter. So HFCs, be it the HDFC, LIC Housing Finance, PNB Housing Finance, HUDCO, all these are what? They form the part of corporate bond market. They basically float the bonds which will be purchased by the investors. NBFCs, we have Mahindra and Mahindra Finance, Tata Motors, Citicorp, Sundaram Finance. Then we have Chola Mandalam Finance, Bajaj Auto Limited. All these are what? Under the part of your corporate bond market. State level undertakings, we have state level power generation corporations. Fine. So whosoever is involved in the power generation, like DHBVN is there in Haryana. Then we have state level power transmission corporation. Power transmission and power generation, different corporations are there. State level power finance corporations are also there. Then we have the state level infrastructure development finance corporations, commonly known as your IDFCs, state level IDFCs. State level electricity boards, state level road transport corporation, state level development corporations, state level industrial development boards, state level municipal bodies. All these are what? Under the state level undertakings, and they also participate in the corporate bond market. Then we have certain institutional participants also, such as banks, primary dealers, mutual funds, insurance companies also. The retirement funds, corporates, all these will be the major players of your corporate bond market. Right? Insurance companies are also involved. After that, you must be knowing that whenever we are discussing the fixed bond market, we say that government security is not at all risky. But what about the corporate bond market? Here, the riskiness will be determined via various ratings. So the corporate bonds, they are priced at a spread over the corresponding government security depending on the level of perceived risk. Whatever the risk is involved, the rating agencies will be determining that and providing the ratings. This is because these bonds are not sovereign bonds, not governed by any government directly, and are serviced by the entities who are issuing them and carry a risk of default. These corporations, do you have the guarantee that none of them will go in loss, or for that matter, they will be always profitable? No. So risk of default is there on the part of entity in fulfilling the interest or principal payment obligations. Fine. So that is the reason why we say that yes, risk is involved in the corporate bond market. Not that high as compared to the equity market, but yes, as compared to the government securities, it is risky. Corporate bonds usually carry a rating, normally triple A. See, all the major rating agencies, they will give the highest rating, the least risky rating as triple A to D. Fine. The chances of defaulting are very high. Then you will get the rating as D, as specified by the rating agencies, depending on the variety of fundamental factors pertaining to the company issuing the bonds. Fine. So the company whosoever is issuing the bond, these rating agencies, Moody's, Standards and Poor's, your Fitch rating agency, they will be judging based on that and ultimately coming up with the ratings for the individuals, or for that matter entities whosoever are participating in the corporate bond market, so that they can have an informed decision. Okay. Next we have that the ratings, they simply indicate what? The level of risk of default on the issuer, with AAA indicating highest safety. These are what? These are highest safety, and D indicating very high probability of default. Here lies the red zone. Fine. Red zone you can call it, the default zone. And in between you will find various nomenclature is there. More or less they will be having some commonality, the most of the rating agencies, but let's just see the Moody's, which is the most important, or for that matter the most common one. So in case of Moody's, let me just erase. Okay, let's just see it like this only. So when you talk about Moody's, AAA means what? The least risky one. Then we have AA, more risky. A, much more risky as compared to AAA. Then we have BBB. This is what? This is the investment grade. Investment grade means what? That till here you can invest. Fine. That is the suggestion from the rating agency. The bonds up to the rating of BBB are categorized as investment grade. But after that, BB, B, CCC, CC, C or D, they are highly risky as per most of the rating agencies. So rating on the bonds is reviewed by rating agencies on regular basis, periodic basis. All the bonds are issued and held in dematerialized form. Fine. Again, the demat form will be there since 2002 as per the RBI regulations. What are the central depositories involved here in this particular rating? There are two central depositories for all the bonds, NSDL as well as CDSL, which we have discussed in the initial remarks of this chapter, where the bonds are held in electronic form. Banks will be taking in which particular form? The account will be opened for a specific ledger name. What is the name of that particular account? Do let me know in the comment section. We have covered this. And when it comes to the demat form, we have the NSDL, the depository who will be taking care of the bond market. Fine. So this was it for today's session. If you have any doubt regarding whatever we have discussed, feel free to ask me in the comments section. And if you are thinking of preparing with us with our paid classes, then you can choose either of these two batches, or for that matter the offerings which we have, JAIIB Mahapack 2.0, or for that matter JAIIB Increment Mahapack. Both are, you can say, the one-stop solution for your preparation needs. If you only want the online study material, then this is your one-stop solution for JAIIB exam. If you want online as well as offline study material in the form of certain books, fine, you will be having 4 books in this particular Increment Mahapack and much more, then you can go with the Increment Mahapack. How you can access them, what all offers are there right now, you can just call us on 981 981 9247, and for maximum discounts you can apply the discount code, that is Y1003. Okay, fine. So now when I say that the theory is complete, whatever we were discussing, it does not mean that the entire chapter is done. Right? The entire chapter, it has bond valuation, bond theorems also, FIMMDA also. So if you have any doubt relating to those topics also, feel free to ask me in the comment section. So see you guys in the next video. Till then, goodbye everybody. Take care.